Financial markets are chaotic, fast-moving systems. But if you watch closely during a strong price trend, the momentum will occasionally pause and stabilize into a tight, recognizable structure before accelerating again. In technical trading, this brief consolidation is called a flag pattern. For active swing traders, it is one of the most reliable short-term chart formations available. By the end of this video, you will have a clear framework to visually identify valid flags on a chart. You will know how to calculate exact profit targets, and you will have precise rules for when to enter and exit your trades. Approaching the market without structure leaves you reacting to noise. Mastering this specific pattern allows you to trade based on calculated, historical data. Step 1 is identifying the correct environment. A valid flag requires a steep, rapid price trend immediately before the pattern forms. If the stock has been meandering or moving slowly, ignore it and look elsewhere. This chart shows exactly what we are looking for. Notice the steep drop, followed by a small upward drifting channel bounded by two parallel trend lines. Now look at the volume bars below. As the flag forms, the trading volume steadily recedes. This upward drift combined with falling volume is deceptive. When prices tick upward during a strong downtrend, inexperienced traders assume the trend is reversing and buy in. But the data tells a different story. A steep entry, a parallel drift against the trend, and dying volume confirm the market is taking a breath, preparing to resume its original direction. Step 2 requires a strict time limit. A valid flag must complete its formation and break out within 3 weeks. This chart displays a flag pattern dragging on for 26 days. The setup loses its structural tightness, morphing into a riskier rectangle. Because consolidation took too long, momentum dissipated. When price finally breaks, it fails to continue the steep trend. You must also filter these setups through the broader market environment. The highest probabilities of success come from aligning your trades with the macro trend. Trade upward breakouts during bull markets and downward breakouts during bear markets. Enforcing that 3-week time limit and checking the overall market trend are your primary defensive filters. They keep you out of setups that lack the mathematical probability to succeed. Once you have a valid setup, step 3 is calculating your target. Flags act as half-staff patterns, meaning they typically form right at the midpoint of a complete price run. Measure the exact price drop from the top of the prior trend, point A, down to the start of the flag, point B. Now project that exact distance downward from the top of the flag, point C, to find your theoretical target price. However, historical data shows that post-breakout moves are often slightly shorter than the initial run. To protect your capital, you should set your actual profit target conservatively, just short of that full measurement. Using the measure rule removes the guesswork. You transition from hoping a stock goes your way to executing a mathematically defined exit strategy. Step 4 is execution. The golden rule here is to never anticipate the breakout. You must wait for the daily price to close completely outside the parallel trend lines before taking a position. Before you execute, you need to verify you have clear airspace. Look left on your chart to locate any historical support or resistance zones that might get in the way of your target. On this chart, a clear trendline support zone sits right beneath the flag. Entering directly into support causes the price drop to stall out. If the price flatlines here, the setup is failing. Manually abort the trade immediately. Holding on to a stalled trade requires you to rely on hope. Professional traders take their small profit or minor loss the moment the expected momentum dies and move on to the next chart. Your long-term profitability as a swing trader relies entirely on your discipline. Wait for the breakout to confirm your entry and cut stalled trades ruthlessly on exit. To review, your process relies on a strict 5-step checklist. Confirm the steep trend, draw the parallel lines, ensure the pattern's under 3 weeks, measure the target, and confirm the breakout. Keep your timeline expectations grounded. Flags are designed for quick, active 2-week swing trades. If you are looking to buy and hold for months, this is not the pattern to use. By applying these visual filters and the measure rule, you stop guessing. You turn brief, chaotic market pauses into predictable, calculated opportunities.